Hi guys, welcome to this video. Friends, in this video, we'll talk about a very relevant topic, how to value startups. We'll discuss in detail, how this valuation of startup is different from, valuation of an established company. What's the difference in the methods of valuation and all. Okay, so we'll be going to discuss everything in detail and with an example also. So just to give you a quick intro here, let me tell you about two college kids who dropped out of Stanford University, went back to India and convinced some of the investors to raise $1 million of funds to fund their business. It sounds crazy, right? Why someone will fund, $1 million, to a business which is not even started? But guys, that's the actual case. And the company name was Zepto, which was founded in 2021. And they were just 19-year-old kids. The business idea was delivering groceries in 10 minutes. Now, I want you to think about what you guys were doing at 19, studying for exams, watching Netflix, and these guys were raising millions of dollars. Guys, by 2024, Zepto was valued $5 billion, and by 2025, it was worth $7 billion. Zero profits, losses of 250 crores every single month. So the obvious question comes in our mind is, are these investors genius or they have completely lost their minds? And the answer, as always in finance, is somewhere in the middle. Today, I'm going to show you the exact method these investors use to justify that valuation. It's called the VC method of valuation, and once you understand it, you will never look at the startup valuation the same way again. So let's start, guys. So here I'll give you a brief history about the startup valuation. So to understand VC method of valuation, we need to go back to the 1957. Not in India, but the Silicon Valley, California. A man named Arthur Rock, widely considered as a father of venture capital, helped a group of engineers to leave their job and start a semiconductor company. That company was Fairchild Semiconductor. Now, here is the funniest part. The engineers who left their job were called traitors 8 by their former boss. So the crime was believing in their ideas was worth funding. But Arthur Rock believed in them, raised the money, and rest is the history. From Fairchild came Intel, and from Intel came the entire modern chip industry. That one bet changed the world. Rock later said, and I love this quote, "I invest in people, not in ideas." And that philosophy became the foundation of venture capital. So guys, fast forward to 1987, a professor at Harvard Business School named Bill Solomon sat down and asked a very practical question. How do you actually put a number on startup that has no profits, no history, nothing? And he came up with a framework, a very clean, logical 4-step process. We call it a VC valuation method. Now, it is used by every major VC firms in the world, from Sequoia Capital and Lightspeed in the US to Nexus and Bloom Venture right here in India. So guys, we'll understand this framework in very much detail with an example also. Now guys, before that, let's quickly understand why traditional methods of valuation fails for startup valuation. So guys, if we want to value established companies, say HDFC Bank, Reliance Industries, Infosys, we use various methods like DCF, PE ratio, EV/EBITDA multiples, etc. And these are the great methods, and I teach these methods in detail in my workshops. But guys, just think of startups. They have no history of revenue. They have no profits, no cash flows. Nothing is there, right? And sometimes there is no product in place. Now, to apply these methods like DCF, relative, you should have some cash flows in place. You should have some numbers in place, right? Because we have to do projections based on the historical trends, right? Now, if you do a startup valuation using, say, DCF, and you can come out with the negative numbers because initially there is so much of the cash, cash is burned in the business growth and all. And say your business valuation is coming 5 crores. Can you present this valuation of minus 5 crores to the promoters? And the answer is no. But it's not like the DCF valuation is wrong. The thing is, you're asking a wrong question here. So in case of VC valuation, the startup valuation, you have to apply some different methods, right? These methods are different from the traditional methods. And why they are more relevant in case of India? Because if I tell you the statistic here, in 2024, India raised $12 billion, almost 20% jump from what they raised in 2023 through the venture capitalist, right? And most of these companies had zero profit, no revenue in place. So clearly, investors are not waiting for profits. They are betting on the future of these companies, right guys? So this is what the whole framework of why the DVC method of valuation is required here and why traditional method of valuation does not work. Okay, now let's move to the next part of the video where we'll understand, how this method works, how to apply this method. Guys, the VC method of valuation is built on one core idea. What price should I pay today so that I can make my target return at exit? That's it. And that's the whole basis of the VC method of valuation. So guys, work backward from the future and be ready to find the current value of the business. So figure out what the company will be worth when you sell it. Then figure out what you have to pay today to make your return. It works in the 4 steps. So step 1 would be estimate the exit value of the startup. Step 2, decide the required return for the VC. Step 3, calculate the post-money valuation. Step 4, calculate the pre-money valuation and equity stake. That's it. So let me walk you through each one of these steps with an example here. Okay, so let's move to the next part of the video where we'll understand, this process with an example here. Now guys, let's create an hypothetical startup, say SwiftMed, okay, an Indian healthcare app delivering medicine to your doorstep in 30 minutes, right? And I'm sure you might be wondering, so in these days, so people are delivering, everything in 10 minutes, so 30 minutes may be too late, right? We are in India in 2026, but suppose this startup was in year 2022, 23 maybe, right? So this startup is focused on delivering medicine to your doorstep in next 30 minutes, okay? Now, they are at a Series A stage, let's assume, and there is no profit. They need 10 crores rupees of the funding from the VC to scale up, and they are projecting 50 crores of the revenue by year 5. Okay, this is their projection. So they're assuming they would have a 50 crores of the revenue by year 5. Maybe the current revenue is very small or there is no revenue at all. And in the step 1, we have to find the exit value. If you apply that 4-step framework here. So if the company gets acquired or it go public after 5 to 7 years, what would be its worth, right? This is what we need to find. So this exit value is also called terminal value also, guys. So the formula is very simple. Exit value is what? Projected revenue multiplied by the industry multiple. And for SwiftMed, my year 5 projected revenue is what? 50 crores. And if I look at the comparable healthcare companies, how they are valued in the market, I get 8 times of the multiple. So exit multiple would be 50 into 8, 400 crores. Now, where this 8 times multiple came from, we can use comparable companies analysis, say past acquisition, listed companies. We can look at the benchmark companies also. And guys, for your reference, Pharmacy was valued $710 million in 2024. And if I look at the multiple of healthcare companies in India, they range from 5 to 12 times, right? Depending on the growth of this company. So based on this, you have to figure out, what's the multiple applicable for this company, considering the growth prospects, etc. Now, step 2 is required return. Now, guys, here's something students always find surprising. When a VC gives you funding, they are not doing you any favor. They are running a business, right? So they need return from their investment. And their business model is very brutal. 1 out of every 10 startups of VC funds, roughly 6 to 7 will fail completely. 1 or 2 will give just a mediocre return and 1 will give a massive return, right? That could be a scenario here. So that one winner needs to pay for all the failures. This is why VC don't say I want 15% return, 20% return. They simply say I want 10x of my money in next 5 years. It sounds greedy, but the maths actually makes sense when you understand the risk. Think about it this way, that if you give 1 crore rupees to every 10 startups and out of 10, 7 of them go zero, right? So you have already lost 7 crore rupees. So now remaining 3 crores need to return not just 3 crore rupees, they have to return back 10 crore rupees of your initial investment plus your profits. That's why they required returns so high. So for SwiftMed, let's say VC want 10x of the return in next 5 years, and that's actually conservative for Series A funding. Earlier stage funding, sometimes VC demands 50 times and even 100 times of the returns. Okay, so these kind of returns they expect when they put their money into high risky business at a very early stage. Now, guys, let's move to the next step, step 3. Post-money valuation. Now the maths comes together beautifully. Post-money valuation is equal to what? Exit value divided by your required multiples. So for SwiftMed, the post-money valuation was 400 crores divided by 10 because that's your required return, So the current valuation comes 40 crore rupees. This is what the VC is willing to value that company, after putting their money. So that's called post-money valuation. Means after putting that 10 crores of funding, the valuation will go to 40 crores. So they are essentially saying that I'll pay you 40 crore rupees for this business today because at that price, I'll make 10x of the return, 400 crores of the valuation, and I'll take exit. So if founder wants higher valuation, they say, okay, I want 60 crores of the valuation. So maybe VC may say no, because I'm not interested in this 60 crores valuation, because at this valuation, I'll not be able to make my required return. So guys, this is why, there is so much tough negotiation goes on between the promoters and the VC funding at the valuation stage. Now guys, let's move to the next step, step 4, pre-money valuation and equity stake. So guys, there are two simple steps and calculations. Pre-money valuation is equal to what? Post-money valuation minus the investment amount. So pre-money valuation was 40 crores because that valuation you will get, the company will get after putting that 10 crores of the investment. So before the 10 crores of the investment, what the valuation is? This 40 crores minus 10 crores, 30 crores. This 30 crores is called pre-money valuation. Now, how much stake equity stake VC should expect when they are putting 10 crores of the investment in the business? They should expect 10 crores versus 40 crores of the post-money valuation. So their stake is considered to be or calculated on the basis of post-money valuation versus the what money they are putting in. So on this basis, they will get 25% return, equity in the business because they are putting 10 crore rupees and the total valuation is coming out to be 40 crore rupees. So guys, now this 10 crore rupees, what they are putting in now will become what? Because the total valuation will jump from what? 40 crores to 400 crores in year 5. Now this 10 crores will also jump to 100 crores in year 5 because this 25% stake in year 5 will comes out to be 100 crore rupees. So this is what a simple logic. They are able to make their return 10 times from the current investment value to the exit value, right guys? Now friends, back to real world, example of Zepto. So when the founders of Zepto started this business, the original name of Zepto was Kirana Cart, and the idea was to partner with the local Kirana shops to deliver the grocery items. But guys, unfortunately, this idea got completely failed. And here is the beautiful lesson: some of the best companies in the world were built on the ashes of the failed ideas. So they rethought about their ideas, the business plan, structure, and they built the dark store model. And the rest is the history. Now apply the VC logic to Zepto's early funding. They put money in at a $1.4 billion valuation in 2023. They were not looking at the losses of 300 crores per month. They were asking one question. Quick commerce in India is at $150 billion of addressable market as per Goldman Sachs, and Zepto is only one of the 3 serious players in this space: Blinkit, Instamart, and Zepto. So if Zepto captures 20 to 25% of that market and they exit at a modest multiple of 3 to 4 times, the maths gets to $10 billion of valuation very quickly. And that's what the VC method in action. Not guessing, not gambling, a structured logical framework applied to uncertain future. By October 2025, Zepto raised $450 million at a $7 billion of valuation, led by one of the America's largest pension fund. And the pension funds don't invest in things they don't understand. They run the same math. And in December 25, Zepto filed for an IPO targeting to raise 11,000 crore rupees, about $1.3 billion in the fresh capital. Now friends, from 2 college kids with a failed startup to $7 billion company heading for an IPO, all because the investors had a framework to justify the bet, right? Now guys, let's quickly understand limitation of this VC method. And I would be doing you disservice if I only tell you good part of this VC method of valuation and not the limitation side. Guys, every valuation methods have some flaws and the VC methods have many flaws. The first limitation is, the multiple, the exit multiple, what you are estimating here. It's just an assumption, and the revenue projection is another assumption. So changing one number can change the valuation entirely. So guys, there's an actual saying, an old saying in the investment banking that give me the valuation you want and I'll give you the assumption to justify it. So that's not a joke. This is how the real thing happens. And this is why you always stress test your assumptions. You run sensitivity analysis, scenario analysis and all, right? And the second limitation is dilution part, guys. The most startups don't raise just one round. They raise seed rounds, then Series A, Series B, and Series C. And in every new rounds of the funding, early, VC stake will get diluted. So this simple method of VC method of valuation does not consider the dilution part, when you do the valuation at the entry stage. But yes, the modified version of startup valuation, they consider that part, the what would be the later dilution, and they consider this dilution part also in their valuation, right guys? But yes, those model would be little complicated compared to the what we have just discussed. That's the simplest form of VC method of valuation. Now guys, the third limitation, and the third limitation is it ignores the human factor, which is the biggest factor and biggest limitation also. The quality of founding team is that it matters a lot, right, in the valuation. Their execution ability, their resilience, and guys, none of that shows up in the formulas, right? Arthur Rock said in 1957 that I invest in the people, not in ideas, and 70 years later that has not changed. So the model gives you the number, but the experience and the judgment tells you whether to trust it or not, right guys? So guys, if we just recap what we have covered in this video, so one, we discussed about the history behind the VC method of valuation from Arthur Rock in 1957 to Bill Salmon in, who developed this framework of valuation, a professor at Harvard in 1987. Two, why traditional methods like DCF or relative valuation completely fails for startup. Three, the four-step VC method of valuation from exit value all the way to the equity stake. And four, a full worked example with SwiftMed with every numbers on the screen. You can see on the screen, Five, how Zepto's real funding journey proves that the framework works, right? And six, the limitation part of this method, which you should know before you apply this method to value any startup. So friends, if you're preparing for CFA exam, IB interviews, or if you want to work in a private equity fund or venture capital fund, this framework of valuation, VC method of valuation will help you a lot. In a financial modeling and valuation course, guys, at the Wall Street School, we go so much deeper than this, right? We build these models in the live spreadsheets. We work with the real company data. So the way it actually happens in the deal, right? This program is given in the link below. So if you like this video, or if you think this video has added any value to this, please do like this video, share it with someone who is serious about the career in finance, and obviously subscribe to our channel, The Wall Street School, for more content like this. So I'll see you in the next video.